Hello and welcome to Hot Commodities. I am Manisha Gupta and the top headlines on the show are: the gold prices recover modestly just to trade above $1,300 per ounce as escalating tensions in Ukraine sap risk appetite, hurting stocks and boosting the safe haven assets. The Brent prices fall below $103 per barrel as Libya increases its oil output and as worries over supply from the key producer Iraq ease. Let's start with the gold prices, which have recovered modestly just above $1,300 per ounce as escalating tensions in Ukraine have sapped the risk appetite for equities, giving a boost to the safe haven assets. While the geopolitical tensions have prompted some safe haven buying for gold, the worries over more downside continue after Friday's fall. On your screens, 1,300 is just about holding. We have more than 0.3% of a decline coming in for prices. The downward pressure on the crude prices also has continued. The Brent is now trading just above $102, more than 1% of a decline on that. The cut comes as Libya has hiked its oil output and concerns of supply worries from Iraq also have eased. For more on the energy space, let's get on board Scott Darling, who's Regional Head of Oil and Gas Research at JP Morgan, and he joins us on the show. Scott, hi, welcome. How long will this trend of high crude oil supply continue, and will the crude oil prices hit further lows by the year end?
Well, thank you very much. JP Morgan's view is actually oil prices, or Brent, will actually recover towards year end. We're forecasting $112 by year end, and we actually think we're in a higher oil price environment over the next few years. JP Morgan forecast $115 Brent next year and $120 in 2016. And there's no doubt that the North American liquids output growth has been a success story. We're forecasting around 1.3 million barrels per day additional this year. The issue is in the medium term, decline rates will see that growth moderate, we think, to half of what the growth is this year by 2016. Which will put actually a little bit more supply pressure on the market in the coming years.
Scott, there also has been a dip for demand for China for oil. Is their demand focus now more towards gas than oil? And there also are reports of about 200 yuan of a cut coming in for the gasoline and diesel prices. Do you see that putting further pressure?
Well, it's true that China, we've seen a moderation of oil demand growth. Indeed, year to date, Chinese oil demand is down 1% year on year. Having said that, gasoline remains a strong point. We've seen gasoline demand growth around double digits for most of the year. And diesel surprised us by being up 5% year on year in June. So perhaps we're starting to see some kind of tentative recovery in the second half of this year. I think more of the moderation reflects the moderation in economic growth rather than wholesale switching for natural gas and transportation, etc.
Scott, the other thing that was putting pressure on prices and which led to 1.5% of cut in the crude prices in the previous week also has been because of IEA. The report has cut oil demand estimates to 2-year lows. Will India step in and buy more oil, considering the cheaper prices and lack of demand elsewhere?
Well, JP Morgan's global oil demand view is we believe incremental demand will average just over 1 million barrels per day each year for the coming years. And that's predicated on reasonably robust economic growth outlook. In Asia, oil demand growth we think will average around 500 to 600,000 barrels per day. India's obviously part of that. I don't think it's significant enough to move the dial too much on terms of that demand number, even if they did come back and start buying aggressively.
Scott, in your opinion, what's the lowest price level that the NYMEX can hit this year now?
Well, we'd concede that perhaps there could be some softening of oil prices in the coming weeks. We're going into refining maintenance season, so you do have incremental demand taken out in the market, perhaps even up to 2 million barrels per day of incremental demand. But by and large, actually, we believe that prices thereafter would be on a rising trend. What we factor in terms of our analysis more long run is a long run oil price or Brent price of around $90. I'm not saying it will get there this year. I'm saying that that's sort of a support level for oil companies to remunerate their cost of capital at a certain oil price.
Scott, this has been a year where we haven't seen any problems or concerns coming in from the hurricane season. How would you look at that impact on the oil prices?
And in terms of the hurricane season, it's true that temporarily we see some spikes if there was a harsher than expected hurricane season. We've seen that in past years. I think it's more significant around oil. Bear in mind, Gulf of Mexico oil output is around sort of 20%-ish of the US's oil production. Less so for natural gas than it's been in the past. The Gulf of Mexico output is around sort of 6% of the country's output. But if we did see any hurricane-related activities, it tends to be more temporary than structural in our view.
Well, the hurricanes or the season really, or the weather really has not been a concern this time around. It has to do with the geopolitical concerns which have been playing on to the prices. What effect on how are you reading what's happening in the Middle East between Ukraine and Russia and Iraq as well?
Yeah, I think the geopolitical risks are certainly around supply and further reinvestment to certain oil areas. EU and US sanctions on Russia can only sort of limit oil output out of that country. The geopolitical issues we're seeing in Iraq may also limit long-term investment in that country. Indeed, JP Morgan's recent oil update, we slashed our Iraqi oil production forecast by almost 1 million barrels per day as of next year. So we're essentially not forecasting any oil supply growth from Iraq, one of the key or fifth largest producing region, more longer term. Libya is another example where, you know, the market has anticipated sort of a recovery in oil barrels, oil production from that country, yet we haven't really seen that over the last few months.
Final question, Scott, and this one is on natural gas. The prices have come below $4 mark this week. Would you expect the prices to see some support, or are you looking at declines continuing?
Yeah, the weakness in US natural gas prices is primarily due to earlier than expected sort of domestic output coming on stream and limited sort of weather-related demand not being there. You know, we're forecasting, you know, a mild seasonal uptick in the fourth quarter, $4.75 we're forecasting on average for the fourth quarter, and then next year we're forecasting around sort of $4.20 for US natural gas.
All right, Scott, pleasure talking to you. Thank you so much for telling us about the opinion of JP Morgan and yours as well on the energy space, but let's also